let's continue. I was trying to discuss on the breakdown of depreciation and amortization adjustments. Okay. By the way, am I clear? Can you hear me well? Huh? Can
Yes,
you hear?
ma'am.
Yes, ma'am.
Despite the
Yes,
problem
ma'am.
in my Wi-Fi, okay lang? Kabatikid ka mo? Ha?
Yes, ma'am.
Nag-record ako,
Yes,
class.
ma'am.
Record ha? So anyway, just call my attention if you cannot hear. Kung di ka hear, di na ginatandog. Hanggang ikatlo. Okay na? O sige. Sige na, now, here we have the summary of depreciation and amortization. I have given this to you also yesterday. However, for the inventory, it was understated. Life is 1 year because during 20x4, the inventory was already charged to cost of sales. Then for the equipment, the annual depreciation is 12,000 charged to the current year and next year. Then we have the building with an amount of 24,000 divided by 4. It's 6,000 to be charged annually and good for 4 years. Now, the bonds payable, there is a difference in the months payable. The book value is 120,000. The fair value is 115,200. In other words, there is an amount of 4,800 which we analyzed yesterday and called it discount on bonds payable. Now the discount on bonds payable is to be amortized over a period of 4 years. So annually, you will be charging amortization of 1,200. So we have the amortization of 1,200 that you will notice we have shown it in our analysis. So for the amount of the bonds payable amortization, I think this is what is the difference between the work of Dayag and the one that we discussed yesterday. Okay? So after that summary of depreciation and amortization, we now go to in the canvas. We have now your the computation as required in letter C. As required in letter C, we have the computation of our uh, partial or proportionate goodwill. The requirement of number one, letter C, is compute for the consolidated stockholders equity as of January 1, 20x4. So we now begin with the consolidated shareholders equity in the books of the parent, common stock and retained earnings. So the total of P's shareholders equity is equal to 960,000. And then we have the NCI's shareholders equity as computed in letter B with partial goodwill for 90,000. So the consolidated shareholders equity on January 1, 20x4 is 1,050,000. Now, on the other hand, if we are going to use the full goodwill or the fair value basis, the parent shareholders equity is 960,000. And that of the NCI using the full goodwill approach is 993,000. That's the NCI's shareholders equity. So the total or the consolidated shareholders' equity is 1,053,000. Okay, so we are through with the requirements in number 1. Now we go to requirement number 2. Determine the following items on December 31, 20x4 and 20x5. Now the first column is related to partial goodwill. Second column is on full goodwill. And the last two columns are for the subsequent year. So we can see cash. You try to analyze. We are adding for December 31, 20x4 based on the balances given for P and S. By the way, let me remind you that Pascal is P and Sax S na lang. Okay, so we are now adding the cash balances of P and S. So the total based on the trial balance is 322,800. I have also given this to you yesterday. For accounts receivable, we have 90 and 60. So you get 150 inventory. Now for inventory, we are now adding the inventory of Pascal is 120,000 and that of Saks is 90,000. The 210,000, we have a debit to inventory for the increase in the value, comparing the fair value and the book value. However, we have a corresponding credit of 6,000 because of charging the inventory to cost of sales. Now, you will find all of this that I'm talking about in the next requirements when we have the elimination entries and the consolidated working papers. So just take note that inventory, you got adjustment. Next, we have land, adding 210,000 and 48,000. So we have the total of 258,000. But we have an adjustment to land because of the undervaluation of 7,200. So you get 265,200. Again, we are adding 7,200. For the equipment now, as stated here, equipment should be shown at net. However, you will find later in the consolidated working paper of our solution that the equipment and the building accounts are not shown at net. They are shown at the original cost and the accumulated depreciation on the credit side. But here we are asked to determine the equipment at net. So net amount of how did we arrive at 273,000? Now, adding the equipment of P, 240,000 is 180,000. So that makes it 420,000. At the bottom, we have the accumulated depreciation accounts with balances of 135,000 and 96,000. So we are going to deduct because they are credit balances. We are also going to add 96,000. Why do we add 96,000? Because we have the undervaluation in the equipment account. So we are adding. Again, you will find this in the adjusting entries as part of the next requirements. So we are adding 96,000 and we deduct 12,000. If you refer to requirement 1B, 12,000 in the analysis of depreciation, the annual depreciation of the equipment is 12,000. So we are again deducting because it is a credit to accumulated depreciation. So again, you try to review on the amounts. We add 240, add 180, then deduct 135, deduct 96, add 96, and deduct 12. That will give us 273. Okay, in thousands. Okay? Now we go to buildings. Again, net ang ginapangayo. So how did we find the amount of 549,000? We are adding the debit balances of 720,000 and 540. Okay, debits. And then for the credits to accumulated depreciation, 405 and 288. Okay. So, then we deduct the amount of 216,000, which amount is considered to be an overvaluation in the building account. So, we are deducting 216,000. And at the same time, we are adding 192,000 and 6,000. So 192,000, that's the amount of decrease stated in solution 1B. 192,000, we are adding that back. And we are finally adding back the amount of 6,000. Why do we add back when this 6,000 is an adjustment to depreciation? It will be a deduction because in the previous years, accumulated depreciation was over-credited. So, take note that the analysis of the equipment account is the reverse in that of the building account, because in the equipment there was an undervaluation, in the building there was an overvaluation. Okay, so let's go back to the analysis of the building account and find out if you will get the amount. So building 720 plus 540 minus 405 minus 288 minus 216 and plus 192 and plus 6. So you'll get the amount of 549,000. Okay, next, investment in stocks is finally zero because in the elimination entries, we are going to eliminate the investment account. Now, in the total assets, actually we have to add the fact that we are asked to determine total assets. Our assets as given from letter A up to F, these are lacking because we still need to insert or add goodwill if we want to determine our total assets. The fact that goodwill is one of the assets. And I know you will not be able to get 1,782,600 even if you will add goodwill, because the solution of Mr. Dayag considered discount on bonds payable among the assets. So discount on bonds payable, as we have treated yesterday, is a deduction from bonds payable. This is what I was trying to tell you, that there are parts of the solution of Mr. Dayag that do not conform with what we did yesterday. But anyway, we understand why, and I'm trying to explain. Okay, first, we have to identify the amount of goodwill. Under the partial goodwill basis, the amount of goodwill is supposed to be 12,000. But 12,000 is the share of the parent. That's equal to 80% of 15,000. 15,000 times 80% is 12,000. However, we are given in the first paragraph the impairment loss for 2,000 x 4, which is 3,750. So we multiply that by 80% being the share of the parent, it will give 3,000. That's the impairment loss. And that impairment loss is a deduction from the goodwill's balance. So under the partial goodwill approach, if the goodwill attributable to the parent is 12,000 and we deduct the impairment loss share of the parent during 2000 x 4, the net amount of the goodwill is 9,000. So it does not really mean that you have to include goodwill because these are the only requirements of the worksheet. However, for purposes of determining total assets, you must add goodwill. Okay? And I mentioned that even if you add goodwill, you will not be able to get 1,782,600 because this solution consider discount on bonds payable as an asset. So if you add discount on bonds payable, the original amount was 4,800 and we have the amortization in 20x4 of 1,200. The net amount is 3,600, which if you include that among the assets, it will correctly give 1,782,600. Okay, but based on what we have learned, discount on bonds payable is a deduction from bonds payable. Am I correct? Am I correct?
Yes, ma'am.
Everybody, you try to respond. Okay.
Yes, ma'am.
How do we treat discount on bonds payable? We have studied this in Intermediate Accounting 3. Discount on bonds payable. The same with stock issuance cost in relation to bond issue cost. They are treated as deduction from bonds payable. So in the solution, I do not know what was the reason why Mr. Dayag included this among the assets. But I have read that in US GAAP, any cost in connection with the issuance of bonds, so we are talking about bond issue costs, are to be treated as assets. Okay, so maybe that's the reason why Mr. Dayag treated bond discount as an asset. But according to the book that I've read, the US GAAP is not usually followed because now that we have the international financial standards or the IFRS, and we do not conform with the US GAAP unless you are following the rules of the US if your business is in the United States. But anywhere in the world, we are conforming with the IFRS. So, anyway, let's just stick to what we have learned. Anyway, we understand each other. Is it clear? Everybody? Everybody is
Ma'am.
clear?
Yes, ma'am.
So, that is what I am trying to tell you, that our solution yesterday, there is a little discrepancy as with regards to the solution given to me by Mr. Dayag. But anyway, we can justify whatever is the change that we made. I hope you are following and understanding why. Okay? So, what is now the total assets? How much is the total assets? Based on our treatment of goodwill we added, and considering that our bond discount will be treated as a deduction from the corresponding bonds payable. Okay, everybody, is it clear? Clear na?
Yes,
So,
ma'am.
Ma'am.
so how much is your total assets? Kahapon natag ko naman no?
One
Much?
1
1
million 779,000.
Okay. 1,779,000. You try adding the individual figures and you must get 1,779,000. If you get the difference, it's really 3,600. Nga amo na ang total dira in the solution of Mr. Dayag. So, what you will be doing, simply, you have to follow with our total assets. Okay? Now, even if you give me a solution guide, but I really take time to study it and spend the whole night possibly. But even if we change, but we have a corresponding reason why. At least we can defend our side, no? Okay? So I hope you understand. Next, we go to accounts payable. Anyway, if I have time again, I will call Mr. Dayag and ask him so as to get his reason why he treated discount on bonds payable as an asset. Maybe that's in relation to the US GAAP, in fairness to our author. Okay? So, let's continue. Accounts payable. Again, we have the total 240,000, adding 120 and 120. Then for bonds payable, we have now 240 and 120. So it's 360. We get the total liabilities as 600,000. However, considering again that we treated discount on bonds payable as a deduction from bonds payable, so that discount on bonds payable will be a deduction in the amount of 3,600. Clear? So that will give us the total liabilities of 593,400. Am I correct? 596,400. The fact that your bonds payable will be 360,000 less the discount of 3,600. 3,600 because we have 4,800 minus 1,200. So it will only be 3,600. So your total liabilities net is 596,400. Is it clear?
Yes,
Everybody?
ma'am.
Yes, ma'am.
Okay. Next, we go to common stock. Common stock, 600,000. We have the retained earnings accumulated of 490,440. Now, in the later part of our solution guide, we have the solution for this amount. However, just to give you an idea of how this was computed, the beginning balance retained earnings of the parent is 360,000. Then we add the share in the net income of the subsidiary of 202,940. We get the total of 562,440. Kaya ang net income of subsidiary, ang share ni parent is 202,440. Now we have solutions for this. 562,440, we deduct the amount of dividends of 72,000. That's the amount of dividend paid by the parent. So the retained earnings balance at the end of the period is 490,440. Actually, that's found in the books of P in relation to requirement number 1, asking for the consolidated or for the retained earnings consolidated balance as stated in solution number 1, it's really the retained earnings balance of the parent. We do not include that of the subsidiary. Okay, now we go to sales, adding the amount of sales of the parent and the subsidiary. We have 720,000. Then with cost of goods sold, again, we are adding cost of goods sold of uh, 204,000 and 138,000. That's 342,000. But we are adding 6,000 as debit to cost of goods sold because of the inventory of 6,000 which was undervalued. So we now get total of 348,000. You will find the supporting entries in our next requirements. Okay? Then we have the next item in our analysis, we have your expenses, including your goodwill impairment. Okay. So what is the final amount of your expenses? We are now given 160,200. Again, we are adding 160,200. That's the final amount. The sum of depreciation expense. Total parent and subsidiary, 84,000. Then other expenses, parent and subsidiary, 66,000. We are now adding goodwill impairment of 3,000. And we are adding based on our requirement in number 2, no? When we got the analysis, we have now your additional amounts to be considered. Here, we have 7,200 for the net changes in the amortization and depreciation of the buildings and your other items to be amortized. So I hope you are now getting the amounts. Please add 88 and we are adding for expenses 84. 84 plus 66. Then we are adding 3. That makes 153. We are adding 7,200. So we are adding 7,200. That gives us the amount of 160,200. We are adding the amount. And finally, it's 160,200. Okay? So I hope you're following. Then we have your controlling interest in net income equal to 202,440. That's the controlling interest in net income. How we got this? Again, we have the supporting computation for 202,000, 202,440. In our analysis, the amount is the net income of the subsidiary of 211,800. We deduct the share of the NCI of 9,360, giving us the balance of 202,440. Again, 211,800, that's the net income of the consolidated net income, subsidiaries net income. 211,800, then we deduct 9,360. The difference is the controlling interest in net income of 202,440. Okay? So we fill that up. We have now your letter S and then letter T. How did we get 9,360? 9,360 is the result of multiplying for 6,800 by 20%. For 6,800 times 20% equals 9,360. What is for 6,800? Now, that is the difference between the controlling or the non-controlling interest. No, we are going to compute for net income of S, 60,000. And then we deduct the allocated excess, including the goodwill impairment that we have computed in 1B for the current year, column 13,200. So 60,000 minus 13,200, that gives us the balance of 46,800. And then we multiply that by 20%. It gives us 9,360. That is how we found 9,360. And we have the net income of the, we have the consolidated net income of 211,800. You can simply add the controlling interest, net income, 202,440 and 9,360. You get 211,800. But in the solution, we are given the process in determining the consolidated net income. Now, let me give this to you, though you will have it in the latter part. The consolidated net income for 20x4 is computed as follows. The net income of P is 168,000. Net income of P. That of S is 60,000. So we get the total of 228,000. Then we deduct the non-controlling interest in net income na NCI in net income, 9,360 that we have computed earlier. Then we have the allocated excess in problem 1B, in solution 1B, I mean, 13,200. And we have the goodwill impairment of 3,000. The goodwill impairment of 3,000, that which is 80% of 3,750. So again, we are adding 9,360, 13,200, and 3,000. The total is 25,440. 560. 25,560. Then we have to deduct that from the total net income of 228,000. We get the controlling interest in consolidated net income of 202,440. Then we add the non-controlling interest, so we get 211,800. Okay? So I hope you're following. Then for our net income, and then in requirement letter B is asking for the common after the retained earnings, then we have the controlling interest, no? So let's continue. Common stock, 600,000. Okay, common stock of 600,000. That's letter V, no? Then letter W, retained earnings or the accumulated profit or loss. So retained earnings or the accumulated profit or loss, we have the amount of 490,440. How did we get this? Retained earnings beginning of P, 360,000. And then we have to add a share in the subsidiary net income of 202,440. So we now get the total of 562,440. We deduct dividends.